The RBA just signaled that interest rate cuts aren't coming as fast as everyone thought. And if you're sitting on $500,000 in cash waiting for property prices to collapse, I need to show you exactly what the data says is actually happening to your money right now. Let's run the numbers. If you've got $500,000 in a savings account earning 4.5% interest, you're making $22,500 per year. Sounds good until you do the second calculation. Inflation in Australia is running at 3.2% to 4%. That means your $500,000 is losing purchasing power at $16,000 to $20,000 per year while you wait. So your actual return after inflation is between $2,500 and $6,500 per year. Now here's what smart money is doing instead. The ASX 200 delivered 10.2% average annual returns over the last 10 years. A diversified index fund tracking that delivers $51,000 per year on $500,000. After inflation of 3.5%, you're actually keeping $43,750 in real purchasing power. The difference between cash and the stock market isn't $22,500 versus $51,000. It's $6,500 versus $43,750 in real money. That's a $37,250 per year gap. Over 5 years while you wait for property to crash, that's $186,250 you've left behind. But here's the thing nobody wants to hear. Property isn't about to crash 30%. The RBA data shows residential prices have stabilized. The average Australian property is down 7% to 9% from the 2022 peak. That's it. Not 25%. Not 40%. Single digits. And the RBA just told us rates aren't falling fast, which means the pressure on prices that caused the decline is now easing. So here's the actual decision you're facing. You can wait another 2 to 3 years for a mythical 30% crash that probably won't arrive on your timeline. During that time, cash earning 4.5% costs you $37,250 per year compared to the stock market. That's $111,750 over 3 years of opportunity cost just by sitting still. Or you can do what the data suggests. Here are the 5 moves institutional investors are making right now. First, move 50% of your cash into a diversified ASX index fund. Not all of it. Half. An ASX 200 index fund, or a global 70/30 split between Australian and international shares. $250,000 at 8.5% average return equals $21,250 per year instead of $11,250. That's $10,000 per month extra income, and it takes 3 minutes to set up. Second, keep $150,000 in cash. Not in a 4.5% savings account. In a high-interest cash management account earning 5.25%. That's $7,875 per year instead of $6,750. You've just made $1,125 per month extra by switching accounts. That's $13,500 per year for changing where your money sits. Third, take the remaining $100,000 and split it between growth assets you actually want to own. Some investors put this into international shares, some into emerging market funds, some into REITs if they want property exposure without the property. A 60% allocation to ASX International Growth Fund at 9% return gives you $5,400 per year. You're now earning $45,625 total across your $500,000 instead of $22,500. That's $23,125 per year extra. Fourth, automated. Set up a monthly investment plan that deposits $500 per month into your index fund, automatically, for the next 24 months. That's $12,000 you're adding to the market while it potentially dips further. If you invest at an average of 8.5% return, in 2 years that's $12,000 becoming $14,280 plus the dividends reinvested. But more importantly, you stop waiting. You stop hoping for the perfect entry point. The average investor who waits for the perfect timing loses to the average investor who just starts. It's not theory. It's data. Fifth, and this is the move nobody talks about. If you still genuinely believe property is going to crash, buy property using the income from your stock portfolio, not your cash. Here's the math. Your $250,000 in shares earning $21,250 per year in dividends covers the interest on a $350,000 mortgage at 6% interest. That's $21,000 per year in mortgage payments covered completely by stock dividend income. You've bought a $350,000 property using zero of your actual cash, and you still have $250,000 in shares working for you. Now here's the compound effect most people miss. Let's say you do this today. You move $250,000 to index funds at 8.5%, keep $150,000 in high-interest cash at 5.25%, put $100,000 in diversified growth at 9%, and automate $500 per month. In month 1, you're earning an extra $2,020 compared to sitting in cash. In year 1, that's $24,240 in additional income. In 5 years at those blended returns of 7.8%, your $500,000 becomes $722,000. If you just left it in cash earning 4.5%, it's $610,000. The difference is $112,000. But here's the part that changes the game. After year 5, if property has finally crashed and you want to buy, you now have $722,000 instead of $610,000. That extra $112,000 is your down payment. That's a 20% deposit on a $560,000 property instead of 15%. That's the difference between bank approval and being declined. Or it's the difference between owning one property and being positioned to own 1.5. The RBA just signaled that the rate cut timeline is longer than expected. That doesn't mean property crashes harder. It means the timeline for property bottoming out just got longer too. And when the bottom finally arrives, the person who's been compounding returns in the stock market will be far better positioned than the person who sat in cash waiting. So here's what you do in the next 48 hours. Open a brokerage account with one of the major Australian brokers. CommSec, CMC Markets, IG, Self-Wealth, or Stake. They all take 10 minutes. Decide your split. I'm suggesting 50% ASX index, 20% cash management, 20% international growth, 10% automated monthly. But the exact split depends on your risk tolerance. Move that first $250,000. Set the automation to $500 per month. Then in 12 months, you'll have made an extra $24,240 in returns you don't have sitting in a savings account earning 4.5%. That's not theory. That's your money working while you actually wait. If this changes how you think about the property bottom, subscribe. We are doing the exact same analysis on property in 3 weeks. New video every Thursday.